What about last Thursday's 1,000 point drop? Let's touch on that one because there's now more information coming out. This is the May 6th 1,000 point drop. A lot of talk about this one.
Okay. Well, tell us. Speak on it.
Well, it's of course it was a lot of vagueness for a few days. People were unsure where it came from, what it was about. I had my thoughts on it, which were duly published in various blogs and on MarketWatch.com. And the basic premise of my assertion was that this was an attack. Basically, it was an attack on the market. Now, you had at the same time circulating the fat finger theory that somebody made a mistake. So, you had another theory that somebody made a typo. They meant to type.
That was the fat finger theory, that they pressed B for billion instead of a million.
Okay. Then you had basically just computers gone wild, I guess, is one theory.
A computer glitch. They said it was a computer glitch, like somebody unplugged the machine accidentally or something like that.
Right, the flash crash. Then you had the theory that the computers basically just shut down for some reason that caused wild problems. Now, according to the last 24 hours, we've got the CFTC,
Gary Gensler, Commodity Futures Trading Commission, isolating the whole problem down to one trader, Waddell. Waddell, yes. E-mini contracts?
That's right, the S&P mini futures contracts.
And it's a merge. He refused to name who the person was or the company was. And it was in testimony in Congress where he said they had isolated it to this pretty large trade, which ended up being 9% of the market in S&P futures that morning.
Yeah.
And it was about $2.4 billion worth of shorts, basically shorting the S&P futures.
That's right.
And it's now emerged that it was just one company, Waddell.
Right. Now, the 75,000 contracts were tossed into the market at one time.
Yes.
And it caused a 1,000 point drop in 15 minutes.
That's correct. Prior to that as well, the markets were already dropping. And in particular, the yen-dollar trade was starting to really unwind fast about an hour before this. So it was the momentum was already down.
Right. Now, so if a single trader is throwing a 75,000 contract order into the market and crashing it by 1,000 points, does that constitute an attack? Or is it a hedge?
Well, they're saying it's a hedge. It was a legitimate hedge.
Right. And the explanation given was that they manage a lot of money in the stock market, and this was meant to hedge. But they also acknowledged two things. Number one, they lost money with the trade. And number two, if you are trying to hedge a portfolio of stocks, the purpose would not be to cause the market to crash. That doesn't add up. Uh-huh. That's not the way you would hedge. You would not hedge a portfolio by throwing 75,000 contracts into the market, sell contracts. That's not a hedge. So you have two choices. Either it's a trade or it's a hedge. Now, the word hedge is used gratuitously and used incorrectly most of the time, as is the phrase market maker. And to me, the hedge argument doesn't make any sense because, first of all, the amount of money under management by this group is not commensurate with this contract in this period of time, in this frame, this time scale, or anything that you would normally associate with a well put together hedge.
Yeah, no, because I forget the size of it, but it's like a $10 billion fund. It's not that huge where they're placing a hedge of $2.5 billion.
That knocked $1 trillion in market value off.
Yeah.
So in other words, if you were not even PIMCO that manages $200 billion, okay, this hedge would even be bigger for them. You see what I'm saying? It doesn't make any sense on the hedging side. So that means that it is, therefore, by process of elimination, a trade, a directional trade, as you would be either a buyer or a seller thinking prices would either go up or down. So therefore, it is a trade. So you have one person making a trade, which is enormous, 75,000 contracts, that attack the market. Now, so my basic premise of an attack by a single person using financial weapons holds up. The first, holds up under this scenario, number one. Number two, the CFTC, Commodity Futures Trading Commission, is also part of the whole regulatory framework that is come under scrutiny by lawmakers who understand now that the regulators and the rating agencies have been co-opted and conflicted by the same group of funds and managers that have essentially hijacked the system for their own private gain. So, and therefore, that's kind of my point I want to make here, is that my thought that this was an attack meant to create destruction still holds up now, a week and a half later. There's nothing I've heard to dissuade me from this basic position. The evidence that we've come out so far from the CFTC now confirms some of the elements of my position. What's missing would be the connection between this group that made the attack and the political operatives who benefited, those people in Washington who had a bill being passed to break up too big to fail banks. Okay, that link has yet to be made, but based on what we've been told so far, that link can still be made. There's still room to make that link because it's an ongoing investigation. They're still saying it's an open mystery, and they're still working on it. So now getting back to the 1,000-point drop in the market, I maintain that the only thing missing now is the connection between the trader that the CFTC has isolated and the folks in Washington. And we know there's a pipeline of information between Washington and Wall Street. We know that going back on this show, we reported 2 years ago that the Federal Drug Administration, the FDA, had opened up a pipeline between Washington and Wall Street to give them first dibs on information relating to drugs that were going to be approved or not approved. They said it would be a way to help, quote, make markets and, quote, hedge, end quote. No, that's insider information. That's market manipulation.
One of the problems, as you mentioned, this insider information of proceeding with financial reform, as they call it, but is that the politicians creating this legislation, of course, have refused to unexempt themselves from insider trading laws. So U.S. politicians have an exemption. They're allowed to trade on insider information.
Yeah.
And they don't want to get rid of this exemption.
No, why not? It's a kleptocracy.
Well, that seems less amazing. It seems like we should have some more storming of parliaments around the world.
Well, it's happening on the periphery countries like Ireland and Greece, and it's working its way to